All right, guys, if you're self-employed and you want to purchase some real estate, maybe you want to refinance some real estate, you don't qualify for the regular bank kind of financing. They said no, maybe your income wasn't good enough, maybe it was credit. There are alternative lending programs that work for self-employed borrowers with excellent options and reasonable rates. If that's you and you want to check them out, this webinar is for you. Check it out. We're going to take a look at options for the self-employed borrower, and we're going to focus on 5 different ways that you can analyze income and with alternative loans. Let's dive in. So first of all, let's talk about what a self-employed borrower is to us. The definition is you're going to own your business for 2 years or longer, and you've owned at least 20% or more of the business, and you can prove that with a business license if you're a sole proprietor that you've had with the state for the last couple of years. Maybe we go to the state recording, we see when you started the business. Maybe you have the operating agreement for your LLC, something like that to prove that you're self-employed. Or perhaps you're an investor in real estate and you've done that for at least 1 full year. That qualifies for self-employed borrower for our definition here. Guys, the first few minutes of this video are going to be some basic information about credit and assets that apply to all loans, including self-employed borrower loans. If you want to skip to the income section, which is unique and specific to self-employed borrowers, go to the time of 4 minutes and 33 seconds and begin there. Before we dig into the 5 different ways to look at income, let's look at some basic things I want you to understand about loans and self-employed borrowers. First of all, I know cash is king in many parts of the world, not in the lending arena because it's hard for us to verify cash. So bringing a big pile of cash to closing and plopping it on the table for escrow for your down payment is not going to work here. Instead, we need to either source or season the liquid assets that you're using for the down payment, the closing costs, and something called liquid reserves, which means we don't want to take your last dollar. We want to make sure you have a certain amount of liquidity, which is defined by the loan program we're working on, so we can talk about that for your specific situation. And we're going to either season it for 60 days. That means 2 months bank statements typically, maybe a quarterly statement for your stock account, something like that, that shows the money's been there for 60 days. Or if we see a large deposit coming in the last 60 days, we're going to source that. Where did it come from? Could be a sale of an asset, could be you got a refund on your tax return, whatever it might be. Those are valid reasons. Cash deposits are a problem because we cannot source those. Understand that going into that, guys, that liquid assets are important here. Credit is equally important. The better your credit, the better your loan. We're going to get a credit report. We're going to take a look at the credit score. We're going to take a look at the number of counts. We're going to look at the derogatory information is there. High credit score, good credit yields a lower rate for the loan, higher loan to value. You can do alternative financing with owner occupied with as low as 5% down. You can do non-owner occupied purchases with as low as 15% down. The rate is better if the credit score is better. You have more options there. In particular, I want you to understand we look at 3 credit scores because of 3 main credit bureaus. We take the middle score in order to price the loan. Scores drive pricing on these kinds of loans, along with what we call loan to value, which means the loan divided by the value and where you're at in that. Lower loan to values equal better interest rates. Higher loan is a riskier loan. The rate's somewhat higher. Major derogatory items are important. Major derogatory means a bankruptcy typically or a foreclosure. If they're greater than 2 years old in the alternative lending arena, you're probably fine for the best pricing round. Then it'll revert to credit score and you'll see what your rate is there. We can still do a loan for you if that major derogatory item, that foreclosure or bankruptcy is less than 2 years, even less than 1 year. It's just going to be a more expensive kind of loan, and we're going to be more conservative on the loan to value there. Let's move along. Income. That's the #1 thing that stops a lot of self-employed borrowers. So we're going to look at 5 different ways to verify income. And I want to point out to you, though, you still need to be employed, self-employed, for a minimum of 2 years or 1 year if a real estate investor, no matter how we're looking at the income, and you're going to see what I mean in a minute here, and it's debt ratio driven. These are not just stated income loans like the old subprime days where lending wasn't very smart. These are smart loans. We're going to verify income in some creative manner, but we're going to know that you have enough income based on what we're looking at there to be able to do the loan. Okay, this is it. Finally, we're going to get into the income portion of this presentation. 5 different ways to analyze income begins now. Hang in there, watch it all the way through. You just might learn something. All right, with that, let's dig in. Method number 1, 2 years tax returns. That's right. That's what you're used to doing with the conventional loans, and that's what can be work in the alternative lending arena as well. We take 2 years of tax returns, we look at the net income, we get the schedules, including if you have an S corporation, we get your S corporation tax return and your personal tax return. Add back non-cash expenses like depreciation. Maybe you can add back capital expenditures, maybe not. That's kind of tricky. But the bottom line is we're going to look at your net income and average it out over a 2-year period, just like conventional. The problem with that is, well, the 2-year average may be too low. Absolutely. Self-employed people are just like all of us. You want to reduce your taxable income so you pay less taxes. If you're self-employed, you have the option of putting large expenses in there with your business. That equals low net income, which yields low taxes paid to the IRS. Unfortunately, low net income to the IRS equals low qualifying income for a loan. So it's a problem. Another problem you might have is what we call declining income. Maybe the year before last, you had a great year, and that last year, the most recent year, wasn't so good. We get the tax returns. We see that your net income is a lot lower on the recent tax return. The underwriter's going to have a problem with that. At the very least, you're going to have to give us a letter of explanation. At the very most, she or he may decline the loan because they don't like the declining income stream. So that can be an issue as well with 2 years of tax returns. So if that doesn't work, how about 1-year tax return? That's right. We'll take a look at the last tax return. Remember that you have to be self-employed for 2 years. That's available on conventional loans too, guys, in case you're not aware of that. But it's a little more specific to situations there. Doesn't work for everybody. It's a specific program in the alternative lending arena for all self-employed borrowers to take a look at. 1-year tax return. The issues are, well, you still may not have enough net income to qualify. We're going to do the same thing. Add back depreciation, those kinds of things. Look at net income. That's what qualifies you for the loan. We understand that cash flow with the business is typically greater than net income, and net income can sometimes be low because you're writing off as much as you can. If you do that, you may not qualify for the loan. So if that's the case, let's look at option number 3, profit and loss statement. That's correct. We will allow you to do a self-prepared profit and loss statement for the last 12 months minimum, showing what the gross income was, what the expenses were, and what the net income is for your business. It's self-prepared, but it will need to be signed off by a CPA or potentially prepared by a CPA. Understand, we're not talking an audited financial statement here, which is very expensive with CPAs. We're talking a simple, self-prepared profit and loss statement for your business for the most recent 12-month period. But there can be issues with that. Like in particular, it can be very difficult to get a CPA to sign off on an unaudited self-prepared profit and loss statement. And if that's the case, you can't get the CPA to sign off, we're not going to be able to use it. Okay, guys, we're finally there. These last 2 ways we're going to take a look at verified income for the self-employed borrower do not use tax returns and are the 2 most common ways that we do loans for our investors buying owner-occupied or maybe non-owner-occupied. If that's you, hang in there. The last 2 ways are coming up now. Go then to option number 4, bank statements for income. That's exactly right. We know that you may run a lot more money through your business or maybe even to your personal account than what your tax return or maybe what the profit loss will show. In particular, tax returns when you write everything off, right? So we will look at the last 12 to 24 months of bank statements, either business or personal, whichever one makes the most sense. We're going to average out the deposits over that time period. So if it's business bank statements, we'll take the 12 months, let's say, average out the total deposits, divide by 12, that's the average, and see how much income is there. If you have enough income, you can potentially qualify for the loan. Now understand, if you have a business, we're typically going to put an expense factor on the business. It may be as high as 50% of the deposits. If that's the case, and you have enough income rolling through, and you can still use half of the average deposits to qualify, you're good. We do have programs which have lower than 50% expense factors, all the way down to 0% expense factor for businesses in some cases. And again, if your personal bank statements have a lot of money rolling through there, that may work with them. And there is no expense factor on the personal bank statements. But there can be some issues with this. Like, for instance, maybe there's not enough valid deposits. What's a valid deposit? A deposit that makes sense for us, that looks like income rolling through your bank account, right? What's not valid? Well, transfers between accounts are not valid, because you could be transferring money out of your business into your personal, back into your business, out and back again a couple, 3 times, and have a lot of deposits coming in over time that we see there, but we don't know if it's the second or third time. So transfers are typically kicked out. Maybe there's different types of deposits with your business, and it's hard for the underwriter to get their mind around it, like understand what those deposits are. Maybe some of them are credit card, which are typically good deposits because you're using credit cards with your clients. Some of them may be checks or deposits. Maybe that makes sense. Some of them are cash deposits. If they're cash deposits and that doesn't appear to be normal for your business, the underwriter may not use those as valid deposits. So we're trying to make sense of it here, guys. These are make sense kind of loans. Also, one other thing that may be a concern is if you have too many non-sufficient fund costs on your bank statements. Even if you roll a lot of money through, if there's a lot of NSFs in there, the underwriter looks at it as bad credit and they can decline the loan and not do it for that reason alone. Okay, so the first 4 don't work. Let's look at number 5, which we call the simple loan. That's exactly right. So simple that we only use the cash flow on the property that you're doing the purchase or refinance for qualifying income for the loan. We take a look at the lease agreements. We take a look at the market rent as established by an appraiser who's going to go out and look at the property, look at other comparables, and tell us what the market rent is for your property. If you're leasing it for more, and you have a lease agreement that shows that, and you can show 12 months payments income on that property supporting that lease, we'll probably use the higher income that you have for the lease there. So the market rents, what we're going to typically do is make sure that there's enough cash flow, lease income on the property to support the mortgage, the principal, interest, taxes, insurance. If there's homeowners association, all of that, it goes into the mortgage payment. What we'd like to see is 1.25 to 1. That means the lease income is 25% greater than what the expenses are for the mortgage with the property. If that doesn't work, we have programs that go 1 to 1. That means the lease income is equal to, not less than, the mortgage payment on the property. If that doesn't work, we have a program that will allow 0.85 to 1. That means that the lease income is lower than the mortgage payment on the property by 15%. We'll allow all of those. You understand that the one where the lease income is lower than the payment is a riskier loan from the lender's perspective. The rate's likely to be higher. The loan to value is likely to be more conservative in that kind of loan. I do want to point out here, though, you can use interest-only payments on the loan to help qualify for more loan here, because an interest-only payment is typically quite a bit less than an amortized payment, and we'll allow that in certain situations, which may be just what you need to qualify for this kind of loan.